The U.S. president claims that a deal to end the war with Iran could be on the horizon, while also warning of fresh strikes across the country and a possible seizure of Iran's major fuel hub. Donald Trump says Washington is in discussions with what he describes as a new and more reasonable regime to end operations in Iran. He threatened to completely obliterate all of Iran's electric generating plants, oil wells, and Kharg Island if a deal is not reached.
I would only say that we're doing extremely well in that negotiation, but you never know with Iran because we negotiate with them and then we always have to blow them up.
Pakistan says it stands ready to support U.S.-Iran negotiations in the coming days. This after it hosted foreign ministers of Saudi Arabia, Egypt and Turkey to discuss ways to end the war. Tehran, however, has called American demands for talks excessive and unreasonable. Strikes continue amid these diplomatic efforts. Tehran says power has been restored in the capital after overnight Israeli strikes hit energy facilities, plunging parts of the city into darkness. Israel's military says it was targeting military infrastructure. Iran has also confirmed the death of IRGC Navy Commander Ali Reza Tangsiri, who was killed in an Israeli strike on Badr Abbas last week. Crude futures extending gains. Brent is headed for a record monthly rise, now trading at around $115 per barrel, while WTI is at $100 per barrel. The benchmarks are at their highest since July 2022, when Russia invaded Ukraine. Iran-backed Yemen-based Houthis now joining the war on the weekend and threatening to shut another route for oil in and out of the Middle East. Fuel prices remained mostly unchanged from Friday. However, diesel prices rose slightly. Since Friday, 95-octane prices for all 5 petrol brands stayed the same. Meanwhile, prices for diesel increased by 20 cents at Caltex, Shell and Esso, and 26 cents at SPC. Diesel prices at Sinopec remained unchanged since Friday. The average for diesel rose by 18 cents at $4.01 per litre, and the average price of 95 octane remained the same since Friday. But as tensions in the Middle East heighten, one analyst warns that the 95 octane could go up to $5 per litre.
Currently, the situation becomes more complicated, so which means that it could probably continue to disrupt the supply of the oil in the future. And there's no sign of the end of the war. So that's why we could probably predict that in the future, the price of the oil in Singapore could rise around $4 per litre for 95 oil. Or if this war is going to last for half a year or even longer, and oil price could have a possibility to go up to $5 for 95 oil.
Singapore stocks dipped slightly today. The benchmark Straits Times Index was down 0.02% to close at 4897.26 points. For the local banks, DBS slipped to $56.97. OCBC reached $21.63, while UOB finished at $36.54. Sembcorp was up 2.77%, closing at $6.68. Keppel was down 0.84%, ending at $11.80. And SIA was also down, closing at $6.60 after a 0.9% dip. Analysts expect a potential closure of the Red Sea to be consequential for Singapore. They say that's because the country is an open economy that relies heavily on global trade. Apart from the Strait of Hormuz, crude oil also passes through the Red Sea from Saudi Arabia to Asia. But that route has seen volatility before. The Houthis, an Iran-backed militant group in Yemen, disrupted traffic for 2 years from late 2023. And with the group entering the conflict, this key shipping lane could be under threat again. And what happens to Singapore if the Red Sea is shut as well? Let's take a look. Singapore sits on the main Asia-Europe shipping lane. If the Red Sea is blocked, ships have to bypass Suez Canal and reroute around the Cape of Good Hope. That adds around 10 days and up to 40% more fuel. This can mean a volatile port traffic, spikes in ship calls, and pressure on port operations. Longer routes will mean higher costs as freight rates could rise. For Singapore, where trade is more than 3 times its GDP, that feeds imported inflation. That can cause higher costs for businesses and consumers. Energy risks could heighten. If both routes are blocked, oil prices could surge and hit record highs again. For Singapore, which relies heavily on imported energy, that likely means higher fuel costs. This has added pressure on industries like aviation, shipping, and manufacturing. And supply chains will begin to stall. Schedules may slip, containers could pile up, and goods arrive late. Delays can ripple through the region, disrupting production and slowing deliveries.
If it is sustained and continues for a period of time, are likely to be quite considerable. We use these routes in order to minimize the cost of shipping, and this helps keeps the cost of the fuels which we consume and the various different other goods and derivative products which come through those regions to be as low as possible. And it's not an accident that over time we've come to consume and import from this region, because that is where the cost is lower.
And for more on this, we speak to Nagunan Thiruchelvam, Head of Consumer and Internet at Alethea Capital. Thanks for joining us this evening. Now, looking at market reactions so far, do you think that the market has already priced in a negotiated end to the war?
The market is looking at 2 contrasting variables. On the one hand, there are daily or hourly reports of an escalation in this very serious conflict. On the other, there are reports of negotiations, whether they're direct or through backdoor negotiations, it's unclear. So the market is struggling to come to comprehension on how to react to these contrasting signals. And that's why we have some volatility at the moment.
And we are seeing that the Strait of Hormuz is closed, and now the Red Sea route, may be under threat as well. What would be the potential risk if both routes remain under pressure?
You see, the Straits of Hormuz is responsible for about 1/5 of the world's oil supply. The Red Sea is also vitally important, but it is much harder to restrict the mobility in that region. And that's why I think the chances of that disrupting oil supply is considerably less than in the case of the Straits of Hormuz.
And how much more damage would a sustained block or a severe disruption in the Strait of Hormuz do to Asian equities and inflation?
Many Asian economies are oil importers, whether it's Japan or Singapore, or whether it's even India, which is an emerging economy.
And China too.
And China as well.
Of course.
Hence, higher oil prices have a huge impact on the level of inflation in these markets.
Right.
Having said that, there are pockets within Asia which might benefit from higher oil prices, higher commodity prices. Some of these markets have exposure to higher commodities.
How would that help some of these markets? Explain that to me. How will higher oil prices help these markets?
There are segments within the Asian equity market, so to speak, where higher commodity prices, higher oil prices, or better prospects for commodity traders, better prospects for oil and gas services operators can be observed from this whole process.
Okay. Now, let's talk about how much more damage. With Brent heading for a record monthly rise, as we said earlier, which assets or sectors are now most at risk in Asia?
The obvious casualties of this whole process are the travel and tourism segment, so to speak, where, let's take in the case of Thai tourism, it means that the extent to which European visitors come to that market would be considerably lowered because it's much more expensive. There's also an aversion to travel.
Yes.
The operating costs of tourism goes up.
Yes.
So you have a drop in volumes and a compression in your margins. So it's a very difficult situation for the travel and tourism segment, so to speak. It's also very difficult for a number of other sectors, food and beverages, for example.
How so?
It means that your input costs go up.
Right.
It means that people's propensity to spend is considerably lower because of the inflation impact. And on the whole, there's a negative impact from this whole development.
Actually, it's interesting you said that because I read a report earlier today that a lot of the fine dining, high-end dining in Singapore have seen reservations drop by 30 to 50%. Would you say that's a natural?
Genevieve, that could be a consequence of a few other factors. It would be possibly a result of lower international travel from a certain segment of countries. It could also be worries on the part of people who frequent these restaurants that economic prospects are going to be very difficult. So I wouldn't read too much into that at the moment.
Okay. Won't it be a natural reaction to people like tightening the belts? They're a bit more worried. With oil prices going up, everything's under pressure. Won't that be an observation?
That's certainly a clear observation from that whole episode.
Okay. Then how did Singapore cope when oil was, more than $100 a barrel during the Arab Spring unrest? And what could be different this time?
Oil prices have risen dramatically in the last 5 weeks. However, in real terms, it's a lot lower than it was in 2008, before the global financial crisis, where we had a commodity price spike. It's a lot lower in real terms compared to the heights of 2011. I'm not sure whether it's lower than what it was during the Ukraine war, but all I'm trying to say is, yes, oil prices are up, but we should not read too much into the absolute price. You need to look at the real price.
Okay. So on that point, when does the oil rally start to derail growth in Asia, or are we already close to that tipping point?
We are not in a position where economists are changing their expectations for GDP growth for the year, because we are still in the process of absorbing whether this is going to be a short, sharp conflict or whether it's going to be a long, drawn-out affair. I would add this factor to the whole discussion, which is that since 2014, there's been historic underinvestment in commodity supply. In the case of oil, in the case of agriculture, in the case of industrial commodities. We may be due for a commodity supercycle where commodity prices, including oil, will be elevated for an extended period.
All right, thanks for the insights. We'll keep an eye on this developing story.
Thank you, Genevieve.
And that was Nagunan Therushelvam from Alethea Capital.